Investing is often seen as the key to financial growth, but the reality is far more complex. While the allure of wealth draws in many, only some are prepared for the challenges that come with it. Success in investing requires patience, discipline, and a clear understanding of the risks involved. It's not about quick wins or avoiding market fluctuations. It's about staying focused on long-term goals and navigating the inevitable ups and downs. Investing isn't just as simple as it seems, and understanding its uncomfortable realities can make all the difference in achieving lasting success. So, how can you navigate these challenges while still staying on track to achieve long-term success? Well, let's get into it. 1. The importance of long-term horizon. One tough reality about investing is that short-term market fluctuations often only matter a little for those focused on the long term. It's easy to get caught up in the market's daily swings, but history consistently shows that investors who stay patient and stick to their plans tend to come out ahead. Take the S&P 500's performance over the last 5 decades. Despite numerous market crashes, corrections, and recessions, it has delivered an annualized return of over 10% as of 2022. To put that into perspective, a $10,000 investment in 1972 would now be worth more than $1 million after adjusting for inflation. The trick is keeping the bigger picture in mind. While it might seem smart to sell during market downturns, it locks in your losses and keeps you from benefiting when the market eventually rebounds. Missing just the 10 best days in the market over a decade can lower your returns by more than 2 percentage points annually. This difference is huge when it comes to wealth building. So, what's the best approach? Stick to your long-term goals. Ignore the short-term noise and ensure your portfolio is diversified and regularly rebalanced to align with your risk tolerance. Don't fall into the trap of trying to time the market or chase the latest trend. The reality is, these strategies rarely work in the long run. Investing is about staying disciplined and patient, and while that might not always feel exciting, it's the key to reaching your financial goals. As Warren Buffett wisely said, the stock market transfers money from the impatient to the patient. 2. Emotional investing can be costly. Emotional investing can be one of the biggest challenges for investors, often leading to poor decisions and missed opportunities. Fear and greed are two main emotions that tend to drive these behaviors. Fear kicks in when the market takes a dip, and investors may panic and sell off their investments, frequently at a loss. On the other hand, during market rallies, greed can push investors to dive into soaring stocks without doing enough research, often leading to regrettable investment choices. Fear during downturns is completely natural. Watching a portfolio lose value can trigger a strong instinct to protect one's capital, causing some to sell hastily. Studies show that emotional selling can cost investors around 1 to 1.5% in annual returns, which adds up over time. This highlights how emotional decisions can drag down long-term returns. Greed, on the flip side, can lead investors to take on more risks than they should. When markets are booming, some feel the urge to jump into hot stocks or sectors without fully understanding the fundamentals, often buying at higher prices and suffering when the market cools down. This behavior leads to the worst strategy, buying high and selling low. It's important to stick to a disciplined investment strategy to keep your emotions in check, focusing on long-term goals. Using dollar cost averaging, where you invest the same amount regularly regardless of market conditions, can help manage volatility and avoid market timing. Diversifying investments across asset classes and sectors also provide a safety net, reducing the urge to make impulsive decisions during market swings. Lastly, understanding biases and reducing exposure to consistent market noise can help investors avoid emotional pitfalls and focus on their long-term objectives. 3. Diversification reduces but doesn't eliminate risk. Diversification is a key strategy to reduce risk by spreading investments across different asset types, sectors, and regions. Its main purpose is to lessen the impact of poor performance from any one investment on the overall portfolio. By including a mix of assets like stocks, bonds, real estate, and others, investors can aim for better returns while smoothing out the ups and downs of market volatility. The concept works because various asset classes tend to react differently to the same market conditions. If one asset is struggling, another might be thriving, which helps balance the overall performance. And well, the advantages of diversification are well known. A diversified portfolio is less likely to suffer large losses because gains in another can offset poor performance in one area. For example, some sectors may be hit hard when the economy dips, while others may perform relatively well. By spreading investments across multiple industries like tech, healthcare, and consumer goods, investors can avoid exposure to any single sector's risk. A portfolio with 25 to 30 stocks can effectively reduce unsystematic risk or the risk tied to individual investments. But it's important to ensure that the investments aren't all moving in the same direction. In times of widespread market downturns, such as during the 2008 financial crisis or the COVID-19 pandemic, nearly all asset classes can drop simultaneously. This highlights one of the limits of diversification. It can't fully protect against market-wide risk. Even the most diversified portfolios can take a hit when the entire market is under pressure. While diversification helps manage specific risks, investors must remember that it doesn't eliminate all risks. Global economic shifts, interest rate changes, and geopolitical events can impact various assets, regardless of diversification efforts. So understanding diversification strengths and limitations is key to managing risk without sacrificing potential growth opportunities. 4. Investing is not a guaranteed path to quick wealth. Investing is often seen as a shortcut to quick wealth, but this belief is false. Many people invest hoping to make rapid gains, influenced by stories of overnight successes. However, the reality is that investing is a long-term process requiring patience, discipline, and a realistic view of potential returns. The idea that investing leads to fast riches is a myth that can result in significant financial losses. Many are drawn to high-risk investments, hoping to cash in on short-term market fluctuations. This approach often leads to impulsive decisions, like buying into speculative stocks or cryptocurrencies at the height of the market hype. Unfortunately, these bets can backfire. Take the dot-com bubble of the late 1990s. Many investors threw money into tech stocks only to see their portfolios collapse when the bubble burst in 2000. Research shows that about 80% of day traders lose money, and many wipe out their investments within a year, highlighting the dangers of chasing quick gains or trying to time the market. For instance, many investors bought popular tech stocks at their peak, spurred by media hype, only to watch the prices crash soon after. While this scenario is common, those who adopt a long-term perspective often fare better. Investors who stayed the course during the 2008 financial crisis saw their portfolio recover, and the S&P 500, which dropped nearly 57%, rebounded with an annualized return of over 10% in the following decade. Patience is the key to investing. Successful investors understand that building wealth takes time and that markets fluctuate. Instead of chasing short-term wins, they set realistic goals and create a thoughtful strategy that aligns with their financial objectives. Investors can achieve steady and sustainable wealth over time by sticking to long-term goals, staying informed, diversifying their portfolios, and resisting the urge to sell during downturns. 5. Fees matter more than you think. Investing fees are often overlooked, but they can majorly impact long-term returns. Many investors must pay more attention to how even small fees can gradually erode their wealth. To maximize growth, one should recognize the various types of fees and understand their effect on net returns. Over time, high fees can significantly reduce investment returns. For instance, research shows that a 1% annual fee might cut total returns by about 30% over 35 years. This impact compounds, meaning the sooner you start paying fees, the more it can eat away your wealth. To illustrate, imagine an investor putting $100,000 into a portfolio expecting a 6% annual return. If fees reduce that return by 1.25%, the portfolio would grow to around $500,000 after 35 years. But if fees were just 0.25%, that investment could reach about $700,000. That $200,000 difference highlights why paying attention to fees is critical. There are various fees investors might encounter. Management fees are charged by funds or advisors for managing assets, usually as a percentage of the assets under management. Transaction costs come with buying or selling securities and can add up if trading frequently. Advisory fees, often over 1% annually, are what investors pay for financial advice, which can be particularly high for small accounts. Some mutual funds have load fees and commissions taken when you buy or sell shares, which can further eat into returns. Also, brokers might charge account maintenance or inactivity fees just for holding or not using an account. But then, minimizing fees involve a few strategies. Opt for low-cost index funds or ETFs with lower expense ratios, as they often outperform more expensive, actively managed funds. Also, by reviewing your portfolio annually, it might help spot high-fee funds that underperform. Investors should also feel comfortable negotiating fees with advisors or brokers. 6. Continuous learning is essential. In the ever-evolving world of finance, continuous learning isn't just a good habit, it's necessary. With financial markets, regulations, and investment products changing consistently, staying informed becomes crucial to any successful investment strategy. A mix of unpredictable factors, such as economic data, global events, and rapid technological advancements, shapes the financial landscape. Take fintech and blockchain, for example. These innovations have shifted traditional investment practices, creating new opportunities and challenges. Additionally, regulatory changes, especially those following financial crisis, can reshape the environment investors must navigate. As these elements evolve, so must the strategies investors use. Failing to stay updated can lead to missed opportunities or serious financial losses. Continuous learning helps investors stay ahead of these changes, giving them the tools to adapt to refine their approaches, ensuring they make smarter, well-informed decisions. Remember, knowledge is power, especially when it comes to investing. So, by keeping up with market trends and emerging opportunities, you will be aligning your strategies with financial goals. For example, understanding how rising interest rates affect portfolios can help investors minimize risk. Moreover, continuous learning fosters adaptability, a quality that defines successful investors. Those who keep learning are better prepared to navigate market disruptions and capitalize on trends as they emerge. Fortunately, there are plenty of resources to support ongoing financial education. 7. You can't control the market, only your actions. One of the most important lessons in investing is understanding that market movements are beyond anyone's control. It might seem frustrating at first, but there's also freedom in realizing investors' only real control is over their own decisions. By shifting focus to factors like diversification, managing costs, and staying disciplined, investors can navigate markets with a purpose and move closer to their financial goals. The market is influenced by countless elements: economic conditions, global events, and the moods of other investors. These factors change constantly, making predicting or influencing market trends nearly impossible. Trying to time the market or follow the latest fads often leads to poor decisions and missed opportunities. Even history's most experienced investors have been blindsided by unexpected downturns. From the dot-com crash to the 2008 financial crisis, this demonstrates the reality: controlling the market isn't possible. However, while markets can't be controlled, an investor's choices can be. Building a diversified portfolio by spreading investments across different assets and regions helps reduce risks, providing a buffer when one sector underperforms. Keeping costs in check, such as minimizing management fees and transaction costs, can significantly impact long-term returns. You can also opt for low-cost options like index funds and ETFs that allow investors to retain more earnings. Undeniably, sticking to a long-term strategy, avoiding emotional decisions during market swings, and staying invested over time have proven to be winning approaches. So, are you ready to face the uncomfortable truths of investing and staying committed to your financial goals? Comment your strategies down below. Also, please leave a like, subscribe, and don't forget to turn on the notification bell for more amazing videos like this one.